Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Welcome back to another episode of Blue Chip Now. You have Daniel Dusina and Matt Mondoux with you today. So after we just recently released our first episode that kind of looked through some recent common client questions, for those of you that if you haven't watched it, we basically spent, I want to say 15, 20 minutes looking at a number of different questions that we commonly have gotten from clients recently. We spent just 2 minutes on each of those questions, and we want to go a little bit deeper on a few of them. And so today, we want to go a little bit deeper on the question, why should I invest in individual stocks as opposed to using another methodology in an investment portfolio? This is something that is near and dear to our hearts at Blue Chip Partners, as we do have an in-house investment department. I lead an investment committee. Matt is a part of that investment committee in which we are building on clients' behalf an equity allocation that consists of generally 25 to 40 individual stocks. So what we really want to talk through today are what we see as some of the benefits to constructing a portfolio in that manner. I've kind of identified, 3 buckets that we're going to dive into today. The first would be related to transparency. The second would be related to cost effectiveness. And then the last one is related to efficiency. You can consider things like tax efficiency related to that. So I guess jumping into it here, Matt, when we talk about the transparency element of being an argument for why you should invest in individual stocks instead of baskets of stocks like a mutual fund or an ETF, what does that exactly mean to you?
Yeah, well, and let's be clear. So what we're talking about is a well-diversified portfolio of individual stocks. What we're not talking about is 10 stocks or
Correct.
5. We are talking about 30 to 40 names, well-diversified across sectors. So we're not talking about 30 technology stocks. We're pretty specifically talking about something that's going to be correlated to broad markets, but instead of just choosing to passively follow the broad market, we are buying individual companies and then the benefits within. So number one, like you said, transparency. I think it's phenomenal when people can open up their statement and see exactly what they hold in their account. When you invest in a mutual fund or an ETF, that data is available, but you have to dig a little bit. When you have a diversified portfolio of individual stocks, you can open it up and see the companies right there listed, the amount of shares that you hold. And I think that from an investor psychology standpoint is phenomenal. It's just a great feature of buying individual companies.
Yeah, and I think jumping off of that, some of the best feedback that we receive as a firm comes from the communication that we send out to our clients after making a change to their equity allocation. When we make a change, so let's just say hypothetically, Matt and I have an investment committee meeting tomorrow. If we come out of that meeting and there has been a change that we've identified, we've voted to make it happen across our internal models, and thus it's going to happen in client accounts. When that trade's happening, our clients who are affected by that will get an email that outlines why we're buying what we're buying, why we're selling what we're selling, and the main reasons behind, the main supporting elements to that decision and the decision-making process. We get fantastic feedback on that. And I think the reason it's so well received is because investors don't get that if you're simply just outsourcing to a mutual fund or an ETF. If it's an ETF, it most likely is going to be somewhat passive in nature. And so, you're not going to get an email every time something moves in or out of the S&P 500. If it's a large mutual fund, the manager in New York or London or San Francisco is not considering Mary and Joe Smith when they're making that change. So they're not going to handcraft an email to you and deliver it to your doorstep. But the transparency element, it's well received because of that kind of attention to detail, and also because of the kind of connotation that comes along with it, right?
Yeah, and they tend to be more one-size-fits-all strategies, to a large degree. They're not really breaking down the investment strategy or the stock allocation and focusing it, like you said, on the end consumer. They have a mutual fund, they have mutual stocks that they buy across all their client base. If they have to trigger capital gains or sell a position, they're not worried that Mr. or Mrs. Smith bought into the mutual fund a month ago, and they could be subject to some type of, adverse tax consequence.
Yeah.
And that we'll dig a little deeper there a little bit later. But the other thing I guess I would highlight though, so why have ETFs, why have passive investing, why have mutual funds gained popularity, to play devil's advocate, right? And the big feature is people tend to be their own worst enemy, right? People can't help themselves but try to churn their portfolio, overtrade their portfolio of individual stocks. It's very uncomfortable to sit there and watch your portfolio go down and you feel like you want to take action when sometimes taking no action is the right thing to do.
Yeah.
So there has been a use for certain people to ride the wave of the market, and it's been a very smooth ride for the past 15 years. It's been incredibly smooth from that regard. But, there are some reasons why it can be appropriate for people if they're not working with a professional, if they feel the need to churn their portfolio and overtrade, it can be something. And that is why some of these different styles of investments have gained popularity recently.
Sure. Yeah. And I guess, like you said at the beginning, everything we're saying today is, I guess, assuming that an investor has the ability to be well diversified.
Yeah.
Like, for example, in our equity model internally, there are a few companies that have a very high price per share. All right. I can think of a few off the top of my head, like a BlackRock and Equinix and Costco, O'Reilly. If you have let's just say $5,000 of investable assets and, you go and buy O'Reilly, which trades over $1,000 a share, that's just not something that we would view as prudent because you don't want one name taking up 25% of your allocation.
Yeah, right? Not well diversified.
No. And so this is all operating under the assumption that you can be well diversified, whatever that portfolio size actually looks like. The other thing I did want to say related to what you were talking about with regards to, there are times when it hypothetically can make sense to just buy a neat bundled package. The one thing that is very important to consider is that because mutual funds and ETFs sometimes offer a little bit less transparency in terms of what's actually being held, if you're not working with a professional, there can be some serious concentration that happens there.
Yeah.
Let's say, you have an S&P 500 index mutual fund, and then, for some extra juice, someone puts in there a technology focused mutual fund. All of a sudden, you could very easily have half of your investment allocation on the equity side allocated to the technology space. Because of that concentration that's developed in equity markets, I think it's a lot easier to fall victim to that concentration risk if you're just allocating to passive ETFs or even active mutual funds. And that's just something that I think is really, really important to consider. Should be spotted by any financial advisor or financial professional, but because the experience has been so good over the last 10 to 15 years, either people ignore it or they haven't identified it.
Yeah, no, and that's a huge risk right now. This was through the end of October, the year-to-date return in the S&P 500 was, 46% of the year-to-date return in the S&P 500 was 5 names: NVIDIA, Apple, Meta, Microsoft, Amazon. So if you're a fund manager, you're managing a mutual fund, your goal, how you get bonused out, your incentive structure purely revolves around you outperforming the market. What are you going to do? You're going to be over-concentrated more so than the market is in those 5 names. So
right.
Absolutely. And that's a great story when the tide is rising, but when the tide pulls back, we've seen this countless times and time again. When you don't diversify well, what can happen to a portfolio in a quick amount of time?
Yeah.
Easy come, easy go to some regard with some of those quick returns.
Yeah. Let's talk about the cost equation. So again, like playing devil's advocate right off the bat, passive ETFs to gain exposure to the equity market are very cheap.
Yep.
We haven't quite gotten to the point where investment managers are paying us to use their products, but we're basically there. You can buy the S&P 500 for 2 basis points now. So that in and of itself is not an argument to not utilize ETFs in any capacity. But when you start layering on the transparency and eventually what we talk about in terms of efficiency, this story holds. But more specifically on costs, what does it cost to own a stock, Matt?
Yeah, that's the beauty. It's zero, right? The cost of owning a share of Home Depot to you is zero. It's just in your portfolio. You're not paying a middleman it's zero.
Right. So no more transaction costs, at least for the most part. You're not technically paying a manager if you're just buying and selling stocks in a brokerage account. And that compares to, let's just say, actively managed mutual funds, where depending on the actual asset class you're looking at, it can be pretty expensive. And I think that's a bit underappreciated because although it's not an expense that shows up on statements, again, here's a lack of transparency.
It does not show up on statements.
It shows up in performance.
Right.
Right. And so let's say you have an 85 basis point management fee. That's going to get subtracted from performance. And it's just a higher hurdle for you to clear in terms of your investment gains. So I think that's pretty important to consider. And even though costs have come down, it's still very much a factor, at least in the active space in equity markets.
Yeah, I mean, no doubt. And, it really does need to be paid attention to because oftentimes these expenses aren't overly easy to find, right? They're, like you said, they're not on the statement. Most people aren't going to go through the exercise of taking 8 mutual funds in their portfolio and going and getting all the expense ratios off of, the fund company website and then modeling out the weightings of each fund to get themselves a weighted expense ratio for their overall portfolio. We do that, but rarely have I come across a client that's brought a portfolio outside in that says, hey, take a look at this, and they've already done that exercise.
Yeah.
So it's not transparent. You do have to dig a little bit. And it is the cost of doing business for outsourcing some portion of portfolio investment.
Yeah. And let me be very clear. I mean, I do think there are certain markets where it very much does pay to go pay somebody else.
Yeah.
I mean,
it can pay. Yeah.
Our expertise, at least at Blue Chip Partners, where we feel the most benefit to our clients in terms of actually going out and identifying that basket of stocks is in the domestic large cap space. Now, when we start talking about other areas, small cap, international markets where we are not boots on the ground, all of a sudden, when you look at some of these markets that are, by the way, meaningfully less efficient than domestic large businesses, it does generally, I guess it can pay to go active and pay somebody else. Now, there is still good and bad in those spaces. But again, we are making that decision on behalf of our clients because if we are going to outsource money, and Matt can attest to this, we do some serious due diligence on who we're actually going to trust and partner with externally. It's not just throwing a dart at a dartboard. I mean, this is weeks, sometimes months worth of due diligence in terms of finding a partner, an external manager that not only can provide good absolute benefit, but also how does it work with your existing allocation?
Yeah.
So the cost is certainly a factor. It shouldn't be the only factor, which is why we're saying don't just blindly go pay 2 basis points for a passive ETF. But it should be considered in the grand scheme of things.
Yeah, no doubt. And then, where it even gets more issues compound is when you'll see some portfolios and they'll have 5 different large cap mutual fund managers. And then we just have this unintended concentration. You have one manager selling Microsoft, the other manager buying Microsoft, all the while the investor is just paying, what could be considered an unreasonable fee for, a overly diversified portfolio that's incredibly inefficient from a tax perspective.
Yeah, there's diversification and there's diversification, right? Just diversifying for the sake of diversifying.
Yeah.
So efficiency. When I talked about, the 3 buckets that we want to talk through in terms of why we think it's beneficial to utilize individual stocks as your equity allocation, the last thing I mentioned was efficiency. And a lot of what we talk about with regards to efficiency does relate back to taxes. Do you want to start that conversation?
Yeah. So, I think the premise here is most people can relate to the fact that most of the time stocks tend to go up. Most stocks tend to go up, but not every stock's going to go up, right? So if we buy 40 companies, maybe 30 of them were positive in that calendar year, 10 weren't. We can take action, assuming in a non-qualified, non-retirement account, we can take action on the tax side at the end of the year or throughout the year to tax loss harvest the portfolio. And this can have an incredible advantage for investors over the long run. And I believe it's something that people should absolutely understand and should be a feature of people's investment strategies. But under that premise, we're mostly investing in businesses that go up. Some don't all the time. It's our job as a manager to harvest those losses. So when stocks work against us, it's our job to harvest the loss. Now we get to bank that loss that we harvested and kind of set it aside. And we can let those losses build up on tax returns, on carry forwards for years. And I always think of the great, a situation where an individual sells a business or they want to buy a house and they want to take a large amount of money out of the portfolio to do so. That will necessitate taking gains. And, again, in a non-retirement account, taking gains means paying some tax. Those losses will offset that we have perhaps over the course of 5 years, those losses will compound and we'll eventually be able to offset that gain for a business sale or potentially, a second home purchase or something along those lines.
Right.
So it's a great feature from the investment side that investing in individual stocks has.
Yeah. And, that's something that we do on a monthly basis where we sit back and we basically survey the entire firm's exposure and try to identify if there is a specific company or set of companies in which it would be beneficial to harvest losses and reap that tax benefit. The next step is to actually review if you want to continue holding that after a 30-day period that's necessary to reap that tax benefit. But the whole idea is that's a very different process that you would experience relative to just partnering with an actively managed mutual fund, right? So when we go and make these changes, we've identified a set of individuals who this tax loss would benefit. We've identified individuals who might still hold this and it's at a gain. We're not going to sell it for them. The reason I say all this is because with mutual funds, the intricacies around taxes are a lot less clear. And intra-year, yes, there might be some semblance of loss realization, but more likely than not, there's going to be a portfolio manager based somewhere else that's, again, not considering Mary and Joe Smith. And when they go out and sell something at massive gains, they don't really care about your own financial situation. They don't care that you also have to recognize gains to pay for that house that you're planning on buying. And so that doesn't get recognized by the investor immediately. But at the end of the year, a mutual fund might pay out the actual capital gains distribution, right? Based on the gains that they realized over the course of the year. Could be very small, could be 1%, could be a lot higher, could be 5% or more, which again, in the grand scheme of things might not be that big of a deal. But the idea is, as an investor, no one's going to know if it's a big deal for me unless I'm having an active dialogue with the individuals that are managing the assets. Right?
Correct.
Which is why that tax efficiency conversation to me is really only possible if you're in this business, which is helping to prepare folks financially and grow wealth. It's not possible unless you are the one actually making the decision because you're having a dialogue with the end investor. The mutual fund firms and the portfolio managers of the large mutual funds just simply aren't doing that. They're not expected to do that. But,
right.
That's a very big part of the conversation to me.
Yeah. At the end of the day, that tax efficiency can go a long way for people. It can be utilized in a number of different cases. And at the end of the day, it's what you do 5 years prior to the need from that portfolio can ultimately have a large tax impact on kind of what you're doing in present day. Yeah. So it's something that needs to occur all along the way, year after year after year, so that the payoff, whenever that's realized, will be significant in the form of tax savings for clients.
Yeah, absolutely.
And investors, yeah.
The last thing, and I don't even know which bucket you want to slot this into, but the ability to, back an investment strategy into a financial plan is something that we talk about a lot. What does that mean? Well, if you have a pool of securities that have been hand curated by an investment team that you partner with that is well aware of your financial situation and has mapped out the details, at least on a projected basis over the next 5 years, all of a sudden having a lot more control on the actual invested securities becomes a lot more beneficial because let's just say you're identifying a pool of dividend-paying companies. You can start to map out what the cash flows look like over the next 5 years, at least potentially. Nothing's guaranteed. But the reason that that's important is because that can start to build just a more holistic financial picture. It can be a lot more user-friendly in terms of building an accurate financial plan relative to partnering with an active mutual fund, for example, where you just quite frankly don't always know what you're going to get. And we can manage portfolios accordingly if there is a cash need, right?
Yeah, and I think people can relate to it. Gives investors something else to focus on, right? When we say that company XYZ's raised their dividend and paid and raised a dividend every year for 25 years, that's a lot more relatable to an individual's time horizon or the time horizon they should be thinking about, other than, hey, what did the stock do last year?
Right.
A lot of times, stock performance is a cumulative effect over years and decades of performance and business developments, things that go on within a business. And kind of having that other thing to focus on, which is the consistency of dividends and dividend growth, can be a nice distraction when the markets or stocks are temporarily down, like years, for instance, 2020. Obviously COVID kind of shut the economy down. Well, companies still paid and raised dividends. So that can get investors through these really challenging pockets of time when they're opening up statements or maybe not opening up statements, and the values of the stock temporarily are keep going down.
Right. And I think the underlying point there is this is a strategy that can help keep you invested.
Yeah.
Which I guess is the exact point that you need to emphasize, right? The biggest mistake an investor can make is not being invested. Right.
Right. I mean, and you could play that back, right? So go back to 2020. Somebody could have felt like they timed the peak of the market, sold everything, paid a ton of tax to do so, felt really good for a couple of weeks. And then before you knew it, the markets are back at all-time highs and they're sitting on a pile of cash not knowing what to do.
Right.
So people who are invested for the long term, can get a little more consistency out of that kind of strategy.
Right. Any final points before I wrap things up here, Matt?
No, I mean, I think that was a pretty good discussion. Like I said, I think transparency, cost, efficiency, these are things I think anybody would want to hear when they're looking at an investment structure. Yeah. So, if you do, why not think individual stocks?
Yeah, 100% agree. So again, this was just kind of a deeper dive on one of those questions that popped up when we just did our most recent recording on common client questions. Say that 5 times fast. It's a nice tongue twister. The reason I say that is because we do plan on going a bit deeper on a number of the questions that came up on that recent podcast. So stay tuned. If you haven't watched that episode, I would highly encourage you to do so. And, we look forward to being able to go down a bit more of a rabbit hole on some of these topics, some of which we could easily spend 50, 60 minutes plus on. So with that, thanks again for joining another episode of Blue Chip Now. We look forward to speaking with you again soon.